Most salaried are quietly overpaying their income tax by anywhere between $20,000 and $100,000 every single year, completely unnecessarily. Not because of any mistake, but simply because they do not know about the deductions that are sitting right there, waiting to be claimed. Today I show you exactly where that money is. Here is a question I want you to think about seriously. If your employer transferred an extra $46,800 directly into your bank account every single year, would you notice? Of course you would. That is $3,900 every month, which is a significant amount for most the average households. Now here is the thing. That money is already yours. Your government created legal deductions and exemptions that allow you to keep exactly that much more of your own earnings. But most salaried employees never claim it fully because no one explained the system to them in simple language. Today on Daksha Luma, we are covering tax-advantaged accounts, tax-saving investments explained completely. I am going to show you every major legal deduction available to taxpayers, how to calculate exactly which tax regime saves you more money, and what specific actions to take before the end of this financial year. Stay with me to the end because I have a side-by-side calculation using real rupee numbers that will show you precisely how much you could be saving. Let us get into it. Let me describe what happens to the average salaried employee's tax situation. In January or February, the HR department sends an email asking for investment proofs. Most employees scramble to find receipts and submit whatever documents they have. Some maximize their tax-advantaged accounts. Most do not. Very few know about the other deductions available to them. The result is that the tax deducted at source, or TDS, from their salary throughout the year is significantly higher than it legally needs to be. At the end of the financial year, many people file tax return, wait for a refund, and feel slightly relieved when it arrives. But they rarely stop to ask, was the refund as large as it should have been? Am I using every legal deduction available to me? The problem is not greed. It is lack of knowledge. The Income Tax Act globally contains hundreds of sections. New rules are added or modified in every budget. And the advice most people get from family, colleagues, or even their own chartered accountants is generic at best. Tax-advantaged accounts, tax-saving investments explained is about taking the time once a year to understand your specific situation, compare your options, and make informed choices that legally minimize your tax burden. This is not tax evasion. Evasion is illegal. This is tax planning, which is not just legal but is explicitly encouraged by the government through the very provisions they created. Ha! And you know what genuinely made me laugh the first time I understood this properly? The solution is not complicated. It is actually really simple. So simple that once you see it, you will wonder why nobody explained it to you years ago. But here is where I have to pause for a second. Because this is also the part that honestly made me sad. Genuinely sad. Because millions of people are missing this every single day. Not because they are not smart. Not because they do not care about their money. Simply because nobody ever sat down and explained it to them clearly. Well, that changes right now. Let me walk you through it step by step. Let us build a complete understanding of tax-advantaged accounts, tax-saving investments explained with everything you need to know. Globally currently has two income tax regimes, and choosing the right one is the single most important tax decision for most salaried employees. The new tax regime has lower tax slab rates but eliminates most deductions. The old tax regime has higher rates but allows a rich set of deductions and exemptions. Tax slabs under the new regime for financial year 2025 to 2026. Income up to $300,000, 0 tax. Income from $300,000 to $700,000, 5%. Income from $700,000 to $10,000, 10%. Income from $10,000 to $1,200,000, 15%. Income from $12,000 to $1,500,000, 20%. Income above $1,500,000, 30%. Important note, a standard deduction of $75,000 is available under the new regime. Also, under Section 87A, if your total taxable income is $700,000 or below, your tax liability is completely zero under the new regime. Tax slabs under the old regime. Income up to $2,500,000, 0. Income from $2.5 to $500,000, 5%. Income from $5 to $10,000, 20%. Income above $10,000, 30%. The old regime allows a large number of deductions that significantly reduce your taxable income before these slab rates apply. The key deductions under the old regime. Tax-advantaged accounts, with a combined limit of $1,500,000 per year. This is the most widely used deduction. Qualifying instruments include Employee Provident Fund contributions, Public Provident Fund, Tax Saving Fund mutual funds, life insurance premiums, home loan principal repayment, NSC, Sukanya Samriddhi Yojana, and children's tuition fees. Most salaried employees already hit this limit through EPF alone, so topping up with PPF or tax saving fund is straightforward. Tax-advantaged account CD1B for NPS contributions, an additional deduction of up to $50,000 per year beyond the tax-advantaged accounts limit. This is separate from and in addition to ADC. If you contribute $50,000 to NPS, this reduces your taxable income by that amount regardless of what you have already claimed under ADC. Section 80D for health insurance premiums, up to $25,000 for premiums paid for yourself, spouse, and children. An additional $25,000 if your parents are below 60 years old, or $50,000 if your parents are senior citizens. Total potential deduction, $75,000. This also covers preventive health checkups up to $5,000. Housing allowance exemption for employees receiving house rent allowance who live in rented accommodation. The exempt amount is calculated as the minimum of three values: actual housing allowance received, 50% of basic salary for metros or 40% for non-metros, and actual rent paid minus 10% of basic salary. Section 24B for home loan interest, up to $200,000 per year can be deducted for interest paid on a home loan for a self-occupied property. Now the critical question for tax-advantaged accounts: tax-saving investments explained, which regime saves you more? The general rule is, if your eligible deductions total less than approximately $2.5 to $3,500,000, the new regime saves you money. If your eligible deductions exceed $3,750,000, the old regime usually wins. For incomes below $700,000, the new regime with zero tax under 87A is almost always better. For incomes above $1,500,000 with significant deductions, run the actual comparison. The Income Tax Portal at incometax.gov.in has a free regime comparison calculator. Let me walk you through tax-advantaged accounts tax-saving investments explained with a concrete comparison using real numbers. Vikram is a software engineer in Hyderabad earning a gross CTC of $1,400,000 per year. His basic salary is $600,000 per year. His housing allowance component is $300,000 per year. He pays $18,000 per month in rent, which is $2,600,000 annually. Here is his old regime calculation with smart tax-advantaged accounts tax-saving investments explained. Gross salary, $14,000,000. Standard deduction, minus $50,000. Housing allowance exemption, rent paid minus 10% of basic equals $216,000 minus $60,000 equals $156,000. Tax-advantaged accounts, EPF contribution approximately $72,000 plus PPF top-up of $78,000, total $150,000. Tax-advantaged account CD1B NPS, $50,000. Section 80D health insurance, $25,000 for self and family. Total deductions, $50,000 plus $156,000 plus $150,000 plus $50,000 plus $25,000 equals $431,000. Taxable income, 14,000,000 minus 4,31,000 equals 969,000. Old regime tax on 969,000, approximately $117,500. After 4% health and education cess, approximately $122,200. Here is his new regime calculation. Gross salary, $14,000,000. Standard deduction, minus $75,000. Taxable income, $13,25,000. New regime tax, approximately $165,000. After 4% cess, approximately $171,600. Old regime saves Bikram, $171,600 minus $122,200 equals $49,400 per year. That is close to $4,100 every month in additional take-home pay just from applying tax-advantaged accounts tax-saving investments explained correctly. And the investments he made to claim ADC and NPS deductions are building his long-term wealth simultaneously. This is the double benefit of smart tax planning. Here is your complete tax action checklist for implementing tax-advantaged accounts tax-saving investments explained this year. Action 1. Run the old versus new regime comparison for your specific income and deductions using the free calculator on the Income Tax Globally portal at incometax.gov.in. This takes 15 minutes and could be worth thousands of dollars. Action 2. Maximize tax-advantaged accounts if you are in the old regime. If your EPF contributions do not already reach $1,500,000, top up with PPF contributions by March 31st. If you want equity exposure with tax benefits, add Tax Saving Fund Mutual Fund SIP. Action 3. Open an NPS Tier 1 account if you do not have one. Contribute $50,000 per year to claim the additional ADCCD 1B deduction. This is over and above your ADC limit. Action 4. Buy comprehensive health insurance for yourself and your parents if you have not already done so. This serves two purposes. It protects your family from catastrophic medical costs and gives you an ADD deduction of up to $75,000 annually. Action 5. Submit your investment declarations to your HR team well before the February deadline. Last-minute submissions often mean the deductions cannot be processed correctly and you end up with a much larger TDS shortfall. Action 6. File your tax return before the July 31st deadline. Do not wait for the last day. File early, check your Form 26AS for correct TDS credit, and verify your AIS. Tax-advantaged accounts tax-saving investments explained is one of the highest return on investment activities you can do with your time. An hour spent understanding your tax situation can save you $30,000 to $60,000. Please share this video with your colleagues. Most salaried employees are overpaying tax right now because of simple gaps in knowledge. This video could fix that for someone. Subscribe to Daksha Luma for daily finance education. See you in the next video. Before you go, I have one small request. If this video gave you even a single insight that you can apply to improve your finances, please hit that subscribe button right now and tap the bell icon. That is the only way YouTube will notify you when our next video goes live. And honestly, every single day we publish a brand new finance education video right here on Daksha Luma. Completely free. No paywalls, no courses to buy. Topics like investing, mutual funds, tax saving, budgeting, and everything in between, all explained simply and practically for you like you and me. If you have questions, drop them in the comments below. I read every single one and reply to as many as I can. Your financial future is absolutely worth investing this time in. Thank you so much for watching. I will see you tomorrow, right here on Daksha Luma. Take care of your money.